Tell me about what Jay Powell said and what you think.
So there wasn't anything new in terms of him saying the Fed can do more. It certainly can if it wants. What was new is he put specific numbers to a couple of things. One is the depth of the contraction this quarter. He talked about 30%. And secondly, the unemployment rate, where he talked about 20 to 25%. And that shows convergence now as to how bad this quarter is going to be. Where there remains disagreement is how quickly the recovery thereafter and how sustained. And his point was that you need things to go well on the health side and the policy side in order for us to have a quick recovery. Otherwise, to quote him, it will take time for the economy to gather momentum. And I think that's absolutely right.
You're a bond guy, but we ask you about equities. We know how you feel about upgrading in quality. You've made that point again and again and again. But we do have some individuals. We got, for example, Mike Wilson over at Morgan Stanley. He's now at 3,000 to 3,250 on the S&P. Jeff Salt thinks we'll get the new highs next year and maybe even be somewhere near 3,400 on the S&P by the end of this year. So it makes a difference, Mohamed. You were of the feeling that we were going to grind lower and maybe retest the lows. Meanwhile, we've had about a 30% bounce. Would you be telling people right now to sell this bounce because we're headed back to the lows that you thought we'd retest? Or would you say, hang on, upgrade in quality, and prepare for the markets to continue to move higher? Have you changed your thinking on the overall ability of the market to go higher?
So, Joe, we are in the third very distinct phase. For the last month, we've basically gone nowhere in terms of the S&P, with a lot more volatility building in the last few weeks. That follows, as you pointed out, early March the 23rd, very sharp fall, and then a partial recovery. And the question now is, how long can we stay in this phase? What we need to break higher, and that's what you're betting on if you think stocks are going to go up, is either a significant improvement in fundamentals, we reopen and we reopen well, or policy actions that are meaningful. The Fed buying a lot more high yield, for example, is a policy action that would be meaningful for stocks. Or third, an improvement in the system. U.S.-China tensions come down. The global economy recovers in a synchronized manner. That's what you were going to talk about, Phil, about how synchronized is the pickup. If you feel confident about one of these three things, yes, this market goes higher. I don't right now. I would like additional evidence. And that's why I think the up in quality is a better bet right now, given the uncertainties, than simply going for a higher index overall.
I mean, we've been flat turning around for a month, but prior to that, the market was up 30%. I mean, that's 3 good years.
And prior to that, we were down even more in terms
I understand that. But if you're just stuck down at the lows when the market was down 35%, I mean, there was a time to stop being bearish. And that
there was a time when I personally, when I said up in quality and bought them, they went up 54%. Yes, there was a time. Yeah. The question is,
and I'm just asking, do you think we're going now back to a Mike Wilson 3,000 to 3,250, or do you think we're going back down to 2,500 on the S&P?
I think you're going to see volatility continue to go up around a downward trend, absent one of those 3 structural breaks.
Okay.
So this is something that you have to update on a daily basis. Meanwhile, if you're up in quality, you get a lot of downside protection, and you still get a claim on the upside.
So do you foresee negative interest rates? I mean, I saw that they're in circles where they used to be absolutely eschewed, saying absolutely not. Now there are at least some people saying, maybe it can happen. I mean, in Europe, we've seen it. You haven't seen the benefits necessarily, but there are certain people making the case at this point. Will it happen here? You still don't think so, and it's not a good idea.
If you're asking me what I think should happen, we should avoid negative rates. And I can keep you for the next half hour telling you why we should avoid negative rates. If you tell me asking me what's going to happen, I tell you I don't know. After the Fed agreed to buy the high yield index and take on significant default risk. This Fed signaled that it's willing to do things that were unthinkable. So I can't tell you that negative rates won't happen. I can tell you I hope they don't happen, because they will cause significant damage to this economy.